Hello, hello. Welcome to the stream. My microphone should not be so quiet now. I was listening to some of the recordings of last week's stream. Like, my microphone tends to cut out a little early. It makes me sound a lot quieter than I actually am. So I adjusted my microphone settings. Everything should sound much, much better. Go ahead and tell me if that's the case in the chat or in the comments of the video. So, we got CPI coming out in the next 24 or so hours. And I've had to answer this question exactly 3 times. I've been asked 3 separate times. What are you expecting for CPI, Joe? What are your expectations going into the event? I covered it in last week's stream, but I went ahead and I responded to a message in the chat on the Plan the Profit Discord, and I just wrote it out for you guys there in big letters. So I'm just gonna read this to you and get this out of the way first. So, what are your thoughts leading into CPI tomorrow? It's going to depend on how it prints. It's with all economic events, it's always it depends on, is there a surprise? Does it come out nominal? Nominal means as expected, as forecasted, or does it surprise to the downside? Surprise to the upside? So it depends on how it prints. A 2% handle would, at a minimum, I think, weaken the US dollar on release. And we're looking at the DXY chart, which is the US dollar index here. A 3% handle would, I think, have the opposite effect. It will probably strengthen the dollar on the release, indicating that inflation is not deflating as quickly as most people anticipate. However, there are good signs or good leading indicators that point us in the direction of 2%. The question now is, how far into the 2% handle are we going to go? Which is where this section comes in. However, if the 2% handle is more like 2.9, which just gets you into 2% handle, rather than something like 2.8, 2.7, 2.6, there's a real risk of reversal for any US dollar weakness realized when CPI prints. So in last week's streams, when I was talking about CPI, my expectations going into CPI this week, that's a key factor here. How strong is the disinflation once we're in a 2% handle? If disinflation accelerates and we're at like that 2.7% spot or lower, or just about, call it 2.8, it's kind of your threshold there, then I would expect on the release some US dollar weakness and then maybe some sort of minor bounce. But if you're getting, again, 3%, 2.9, maybe even 2.8, you could end up with some US dollar weakness off the bat and then see that get faded. Because 3, 2.9, 2.8% CPI is not going to change the future expectation of the rate hike path for the FOMC. And it's probably going to impact yields a bit, US yields a bit, but also not super significantly, at least over the medium term. In the short term, you could see an impact over the day or a couple of days or throughout this week, but the likelihood that that holds going into the rest of February, maybe early March, until we get the February CPI in the middle of March before the March FOMC meeting, you could see more volatility in up and down peak and troughs. However, if CPI were to come out at 2.7 or below, that's a significant disinflationary acceleration. And that would drive momentum. This last sentence here is an acceleration in disinflation is needed to ward off US dollar strength. A more linear disinflation, so 3%, 2.9%, I think would lead to more dramatic peaks and troughs rather than a momentum-driven trend. So things can get tricky, especially once we get into March, as we get the next February CPI and see if CPI does continue this trend into the middle 2% handle and continues on that path. It makes the March, or rather the May FOMC meeting, a much higher probability of it being the first rate cut. March is kind of off the table at the moment. But if you get significant disinflation, you're going to end up with a more dovish March meeting and then probably some more volatile peaks and troughs going into the May meeting that are net mean, drifting against US dollar strength. So a lot rides on inflation, and that's been the story for many years now, because what the Fed does is really, really important, at least when it comes down to the FX markets and future expectations and growth of the country, and vis-a-vis for all central banks in their respective countries. So going into this week, we have a couple of drawings here. These are my expectations from 4 days ago. And these are drawn based off these expectations. Go ahead and set up the low so you can see these low odds here. We're to hit the probability weighted pivot at 103.99. If you see more downside, it's not terribly strong downside, at least over the last 16 years. The upside is a bit more volatile. 50% of the time you get your high around here below 104.47, and then the rest of the time you're finding your high somewhere above that, with most, around half of those occurrences around here, which is why we set this expectation. And this is on maybe a 3%, a 3.1%, a 2.9% move in the CPI. So I have quite a great deal of uncertainty when it comes down to what the CPI is actually going to print at. It seems like it's going to print in the 2% handle based off the expectations that I've seen from the outlooks that I've read. But you never take that for granted. You never take it for granted. There's an expectation of a 2% handle. And then it's a matter of, okay, now with this new bit of information, once the CPI has actually been realized, how does that qualitatively update my future expectations for XYZ asset? So with this in mind, let's go ahead and start looking at, I'll go ahead and keep this expectation as is. Let's go ahead and go through the major USD FX pairs. Let's look at the S&P, the NASDAQ, And then let's look at Bitcoin, oil, gold, and see where we are today. And by the way, a new daily candle, I believe, just opened. So how about instead of focusing on the week ahead trade plans, which we've already done, we try and focus on these ranges for the day ahead. Now, given tomorrow's CPI, and the CPI can create some instantaneous volatility, some jumps, I'd be cautious following these expectations, these probabilities to a T. Because remember, these are the distributions given all the historical data, and not every single day is going to be as volatile as a CPI day. So let's just use this as a guardrail, as a guideline, and go from there. Starting with euro dollar. So the expectation that we'd get our negative drift here on euro dollar has followed through. This would be the scenario where we get our 2% handle on CPI, which does line up with our weekly expectations for the euro dollar. Net, probably catch a low here or catch a low there, again, depending on the volatility. It's going to be quite tricky, because when CPI releases, you can have spikes down 20, 30, 40 pips, and then it instantaneously reverses and then goes to new highs, or it just starts moving in one direction and doesn't stop for effectively the rest of the day. It's especially hard when you're a human being trying to compete against high frequency traders with strategies around economic events. So I'm not going to try and predict what CPI is going to be. I'm going to figure out what my expectations are in different scenarios, and then set my positions post CPI, or when CPI is actually realized at that moment. And I'm looking at this so far, following the plan. Aussie dollar, following the plan so far. A lot of hate around Aussie dollar right now, especially if we go and we check out the yields. You can see the yields are only slightly improving here. It seems like most of the pressure that's creating a lot of these red bars here is coming from the long-term yield spread. So this thing can actually flip, and we could see some positive yield spread movement coming in ahead of us, and we might not get this bearish expectation if we continue to see positive yield spread movement going into CPI and post CPI, given that it's a 2% handle. Let's check out New Zealand. New Zealand is kind of the darling of the FX space right now. It had excellent performance over the last week. And this week, we're so far holding at a likely low. We had this trade in the trading group, or at least in my thread where I'm posting my trades. We had this thing, nice stop setup. Get out of replay mode here. And now looking at this period, it seems like there's more risk of getting my stop hit. So maybe I get out of this trade before the CPI comes in and just hop back in after CPI comes out. I don't want to be adjusting this position right now because I don't know if you noticed, but these spreads here at the open between the bid and the ask are quite wide. So I'm not particularly keen on modifying positions right at the open when this spread between the bid and the ask is very, very large. We'll see how the day progresses. If we drift lower, drift higher, going into the CPI, and we'll also monitor the yield spreads and see if these things continue to stay green and positive and potentially increase going into the CPI. Awesome. Let's check out USD CAD. USD CAD is a slugger. It's been considerably low volatility except for this spike here and this spike here, but hit a likely low on the week right around here. These yield spreads, again, aren't particularly supportive, but they're not particularly bearish except for the short term, which can flip rather quickly. Real quick. Yeah, looks like we're going to have to be adjusting this expectation. So this is from 6 days ago. Let's go ahead and look at our lows. And there's still quite a bit of downside potential. Over the last 21 years, a lot of lows are around this spot right here, around the 134 mark. Let's go ahead and pull up our ranges. Yeah, I'd be cautious of another move lower. So this would be a dollar weakness expectation. Going lower on USD CAD means the US dollar is weakening against the Canadian dollar. Going below this prior low puts us into a low probability space. So I'd set up the expectation of going down here to the mid 133s on that release, if CPI turns out all right. Otherwise, it could be a bit of a continued sluggishness on the Canadian side. They also have some issues going on with their commodities right now, with the price of oil not being so fantastic. They're not, again, there's a housing issue also in Canada. Canada has one of the worst housing markets right now for millennials, for young people. A lot of brain drain out of Canada right now because of that. Let's check out the pound. Well, it sort of followed the expectation from 3 days ago on the 9th. We had set an expectation that we'd reach these prices at a later point in time, but we hit this spot right here close to the first 12 hours of the week. I said this was a particularly tricky pair for me to set an expectation on last week. So all I have is an up move and then going down to a close, which is roughly around here. In the scenario where you do get a definitive disinflationary number in the two handle, I would not be surprised to see the Great British Pound close, call it 100 pips higher, essentially, on the week. But yeah, either it's got to find your low around here or somewhere around this mid 125 handle. Yeah, going this high up, you don't go there all too frequently. So upside on the Great British Pound, I'd say, is capped. But next week you got a bit more uncertainty next week. That'll be interesting to do analysis on once we get closer, call it Thursday, Friday, to look at where these ranges and where these probabilities are lining up. And that is the FX section. Let's go ahead and check out the ES and NQ. So the forecasts are kind of all over the place here as far as ES expectations. 4 days ago, we had the expectation of down, up, and then closing lower. A day later, we said, well, if you do get this continued momentum higher, you're probably going to check this higher somewhere between 50, 70, 50, 100 spot. And I started to actually see some analysis from a few institutions calling this spot out precisely. And we're calling this spot out because it's also the edge of the distribution here on the month. Once you start going past this area here around, call it 50.80, 50.90, it starts to become a guess where you end up topping out if you do get this continued momentum past these levels here. So any sort of S&P bear probably is going to want to take shots on the short side there. And that roughly lines up with this monthly distribution. Again, this red spot is where you have the highest density of highs that occur for the week, and vis-a-vis for your lows with this green highlight here. And a lot of your closes end up around here. You can see why we update our expectations from day to day. And let's check it out on the day itself. Going into tomorrow, we're still not in the next trading period here, but at least the indicator lets us see the next period's ranges. So when we want to use this for looking at daily ranges, we can do that. So most of your lows probably going to end up around, call it the 50-20s. And then again, if you get disinflationary CPI, I would instead look at these higher levels here going into the 50-60s for, call it the next couple of days here. All right, let's check out NQ. NQ had a bit more of a straightforward reversal. Check that out. A lot of your highs show up in this peak here or in this peak here for the week. Looks like we topped out there. Now we have a more gradual declining probability distribution that tails and tails and tails. Look how far that goes. So I would definitely be careful past this spot here, past this 50th percentile. This little orange dotted line with the 50 on it. It identifies where 50% of your probabilities are above here and 50% of your probabilities are below here. And you can see that the spread of that 50% below is very, very wide. As far as tomorrow goes, we have a few more distinct clusters. So if this bearishness were to continue, I'd expect, call it the mid 17,800s. That looks pretty darn good. I don't know if we'll end up seeing that particular level, especially on a 2-handle on the CPI disinflationary. That would be roughly around here, probably right on the money at 17,900. And we can look at the upside. Again, if you get that disinflationary spike, I don't know if you're going to get this or not. I mean, if you do, it does seem like this spot here seems quite likely. That would be the mid 18,200s, somewhere around here. Quite a lot of variability around that exact target, but above 18,200 would be my bullish expectation. And let's check out our bearish expectations. 33% of the time, the low is above this 17,888 figure. That kind of lines up with our daily expectation of staying above 17.9. Over the last 24 years, 33% of the time, the low for this week is above 17,888. However, cracking that, you're now checking out these spots down here. And this is where you start to get some uncertainty, like I pointed out in the distribution, where you end up in a guessing zone. And that lines up with this indicator here, 16.67, 25%. Yeah, you'll likely find the low this week around here on a down move. But man, there is some tails here, and you can see that in the distribution right around here. It's neat how the tails in the probability pivot points, a seasonal indicator, lines up with the continuous probability distribution tails that we've set up here. Roughly around here is where you get your cutoff before you start seeing very low tail odds, and right around here is also where you start seeing very low seasonal probability odds. Nice that those things line up. All right, let's go ahead and check out gold. I think I'll pull up GC, but I believe I have drawings on here. Yes. And I'm glad I pulled up this chart. I haven't looked at this chart since the last time I drew these arrows. That was a nice call. Yeah. So right on point. Oh, again, lock that in place so I don't do that again. Again, it's important that day to day, when you look at the chart and you check out your expectations given new information, that you just figure out what those expectations are, you come clean with them, you express them in some way, you write them down, you post a trade plan. Because look, February 8th, this was my net expectation. February 9th, this was my net expectation. Expectations change over time, and they can change quite quickly. Markets are chaotic in nature, and the initial conditions, they can dramatically change your outlook for the day ahead or the week ahead. And what makes someone a trader is when you can figure out new information, interpret it properly, and figure out what the change in those expectations mean for XYZ asset. All right, let's go ahead and check out crude. We had a bit more bearish expectation on crude. It seems a bit more bullish. This could actually provide a decent amount of support for the Canadian dollar, right? What I said earlier. But it looks like the bearish expectation didn't exactly reach the depth, but we did get that slight wick. Again, that sort of stuff sucks. But when it occurs, this is a scenario where you may need to update your expectation from here, right? From February 9th to something more in line with these expectations here, especially on a 2% CPI handle providing more growth, better outlook for rate cuts from the Fed. And yeah, we'll just go ahead real quick, bring up these monthly ranges. Because last week I drew these boxes here, this box here from 4 days ago, highlighting this peak and where a lot of highs for the month typically occur on oil. So on more bullish expectations for oil, I would expect us to tap this $80 price range, and then I'd consider this an overshoot. I'd expect some short selling around this spot. And I believe if I look at the high odds based off the seasonal pivot probabilities, yeah, going past this 82.58 mark, you only do that, what's that, 22-ish percent of the time, 25-ish percent of the time, seasonally over the last 34 years. So I'd expect more bearish resistance around these prices if oil reaches these prices over the next week. And you can see I have two blue arrows here. Blue are my closing expectations. Real quick, bringing up the closing odds. You can see why that is. A lot of the closes for any given week on oil are around this peak. If you do get the higher move in oil, it's harder to close down here, so it'll probably end up closing around the 48 handle. If you do reach this spot nominally and then come down nominally. But again, if you get significant momentum, you could end up very easily closing up there. We can actually look at the closing odds on the seasonal pivot probabilities indicator. So you do close up here. Fair bit of the time, not all that likely, but I would expect the close this week to be below the $80 handle on oil. Now to Bitcoin. Bitcoin had a great move today. It's reaching 50K right about now. I mean, it tapped 50K already. The high of today was 50.322. I had bearish expectations, thinking we were going to go and drift into a likely low and then go higher. But it seems like we'll probably end up closing much, much higher. Yeah, check that out. A lot of closes up here for this particular week over the last 13 years of data we have available here on the Bitcoin historical index. What's that? Close to 40%. It's not exactly 40%. It's like 30.8, 38, 39% of the time your close this particular week is going to be above 51.6K. So I'd expect another $2,000 to $4,000 move out of Bitcoin, potentially closing at these spots up here. Not too much information there. Let's go ahead, look at our high odds. And yeah. So here's the situation as I see it. A lot of your highs on Bitcoin are either going to be effectively coming in right about now below this 51K level, or you're going to end up with a more significant move into that $2,000, $4,000 move higher at some point this week. And that's going to be contingent on cracking this spot roughly here. So this would be a continuation expectation. Let's go ahead and look at our high odds here. Let's go ahead and put that right about there. Go ahead and check our probabilities here. Something along those lines, I believe. Yep, that's exactly right. And then you can see this is the edge of your distribution before you end up with the exponential tail moves here on Bitcoin for a given week. So I'd expect a lot of your highs, if you do get this rip roar and a tear up in this area, to be roughly in this area around that probability weighted pivot in the 53K handle. All right. Let's go ahead and check out if anyone else in the chat wants me to look at an asset. I'm going to bring up ARK real quick. Let's go ahead and bring up the distributions here. It looks like ARK is at a likely high here on the week. Yeah, that looks quite choppy here on the daily. Let's check out on the monthly. Wow, it has really been going nuts, huh? Kathy Wood must be quite happy to have some relief. Again, likely low for the month. Pass through here. I'd say the next likely spot for a top on the month is around the 52, high $51 mark. And that lines up with this peak right here. It is grayed out, but you can see the probabilities start to shrink along this axis here. They shrink, they even go below 2% here. They increase around here, hitting 2.5%, and then they tail off. So if ARK is in for another set of jumps this week, I'd expect the high 51s, low 52s. All right. We can also check out NVIDIA. This comb, by the way, is a set of recommendations and expectations over the year ahead from analysts. And this is TradingView data. And you can see we have a negative drift here on the mean, which is this gray line, and on the median, which is this orange line here. The maximum analyst forecast is going up to 1100, and the minimum bearish forecast is $408, $410, but that's a year out expectations. Oh, I just wanted to toggle that. It does seem like we're reaching the edge of this distribution. I definitely would be careful. This is definitely chasing, going long at these spots here. Wow, check that out. The high over the last 12 hours was right here. That would have been sweet to catch. Sweet to catch. Yeah, let's go ahead and check out some closing odds here on NVIDIA. It's got a bit of a positive drift, but considering how high it is, I would be concerned about the risk reversal possibilities here. Okay. With that all said and done, I'll go ahead and probably end the stream here. We do have one other thing to talk about. At least I'll end the trading analysis segment of the stream. I'll go ahead and pull up the DXY as just a placeholder. I wanted to talk about this in the last stream, but my computer blue screened on me because it didn't have enough memory in my computer. Fixed that, not a problem. This is the Leap. It's a trading competition, a paper trading competition that TradingView is holding. They currently have almost 10,000 people signed up, and you can join this competition until March 15th, 2024. And you trade from March 1st to March 31st. So the latest you can sign up is March 15th. So if you sign up now, come March 1st, you can compete in a paper trading competition directly on TradingView and potentially win some cash prizes. Now, because 10,000 plus people are going to be signing up, there's going to be some people who just go at the max position on the tradable assets for this competition and just have insane profits, because the way you win this competition is strictly by having the largest P&L on your account in the competition. Not on if it's risk adjusted, not on if you were making necessarily smart decisions, but I also didn't see anything in the terms of the competition about using multiple accounts. So there will be people who sign up for the lowest level of TradingView. And by the way, in order to claim these cash prizes, you do have to have a TradingView subscription, even if it's the lowest tier. But you can participate without a TradingView subscription. But I can imagine that someone gets 5, 6, 10 accounts with the lowest TradingView subscription option, and then try and degen their way to these top places. All sorts of people try and game these sorts of trading competitions. However, I love this idea and I absolutely support this. I might even participate just for the audience's sake here for my streams. So let me know if you want me to do this, because, I'm already trading. I don't need to do extra paper trading on top of this. And the amount of assets you can trade, I believe it's Bitcoin, Eurodollar, S&P, and gold. There's only 4 or some odd assets you can trade. So it's quite limited in the universe of assets that you can trade. That'd be my biggest complaint about this, not the, oh, what if someone makes 10 accounts, da 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 da. I love this idea, and I hope that they do one of these every quarter. I hope that they do one every quarter. Or every month, that they have a continuously running trading competition with seasons, and then they get more advanced with not necessarily focusing on absolute P&L returns, but on risk-adjusted returns. Were you smart with your P&L? What was your major drawdown? That'd be interesting, instead of having the winner of the competition being the person with the biggest P&L. Have the winner of the competition be the person with the biggest P&L and the lowest drawdown for the amount of risk they were taking every trade. And I'm pretty sure that they've thought about that, but for the very first one, I think this is a good way to approach it and to get people introduced to the idea, because TradingView has such a wide reach in the retail space when it comes down to trading. So I hope you guys decide to participate in the Leap, and I'll probably end up competing and showing it on the stream. Don't know how involved I'll be in it, but I can do that. Okay. I've pretty much covered everything I wanted to. I went over all of the assets I wanted to cover. I covered US CPI, and I finally got to talk about the TradingView competition. And by the way, the decision to run no music here was intentional because I do plan on actually doing videos going forward if I can. And I find having the background music makes it hard to, when I'm doing clips and cuts between what I'm saying, it also clips and cuts the music and it jumps the music. So I can add music in post for the videos if I end up following through on that. I got to figure out like an editing style. I want to keep it simple when I start off if I do. Okay. I'll go ahead and end the stream here. We're at 50 minutes, sub 1 hour. I hope you guys have enjoyed. And again, tell me if you prefer this microphone volume. I think it's going to be much easier to hear and understand what it is exactly that I'm saying. And yeah, I'll see you guys in a bit.